And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source. Well, if you're just joining us for today, I just want to say a very special welcome now. For those of you that don't know, maybe this program is new to you, and if so, I want to just give you a very warm welcome. But the reality is that you can come to this place as a safe place of learning, a place that you can begin to educate yourself on how to go from the accumulation stage of your life to the distribution stage of your life. Because in all honesty, it's not the accumulation stage that's hard. It's not the accumulation stage that is challenging and difficult, although there's scary moments, yes. It is the distribution stage. It's the stage in which you now have to make this money last the rest of your life. And you got to know how to do it. You got to do it right. So I'm committed as an advisor and a fiduciary to doing what I can to help educate you, to challenge ideas, to challenge conventional ways of thinking, and to get you to really consider what you're doing and how you're doing it so that you can be a successful retiree, a person who retires with more income than what you really need. Now, today we're going to start off this program by just asking the question, in general, does history tend to repeat itself? Now, I know that's a very loaded question. It's a very, very heavy question with great, shall we say, implication. But it's a question that I want you to consider. It's a question that I think all of us need to consider, because as an advisor and a fiduciary, as I look around at what's happening today in today's world, today's market, I see that there's a great deal of contrast and parallel between today's market and the environment that we're in and that of the Roaring '20s. Now, I know immediately some of you right there just started rolling your eyes at me and you're saying, for crying out loud, it's just now getting good, and now you're telling me that it's the Roaring '20s. And the answer is no. I'm not saying that at all. What I'm asking you to consider is there parallels between the two? Because let's just think about what happened this week. This week, we saw a landmark negotiation deal between the European Union and the United States of America. Now, whether you love him, whether you hate him, I don't care. But the reality is that President Trump has earned the moniker of the great negotiator for a reason. Okay? We're not talking Ronald Reagan, the great communicator. We're talking President Trump, the great negotiator. And negotiate this man can. And we've seen it time and time again. And with something as landmark as the European Union agreeing to these negotiation terms, it has allowed what many in America and within the world of finance and the market and the economy are calling a negotiation that allowed us to be able to avoid a full-blown trade war. And that's an awesome thing. Now, the funny part about all of this is the European Union President, Ursula von der Leyen. And I'm sorry, but I can't say that name without thinking about the Muppets and the Swedish chef. President Ursula von der Leyen. I just can't say it with a straight face. I'm sorry, I can't. But nevertheless, this is a record-breaking deal. Now, here's the thing. That was just another bit of fuel being thrown onto the fire. Because it's not just our stock market, it's the world's stock market. We are interconnected. We are seeing all sorts of things improve. We're seeing the euro strengthening. We're seeing the Asian stock market up. We're seeing our own stock market up. These things tend to create an upward momentum within the stock market. And that's all good, right? I mean, that's the reason why we invest in the stock market. We want the stock market to go to the moon. We want it to grow and to compound and to get bigger. That's the whole reason we're taking on the risk, right? And the answer is yes. We want compounding. We want good markets. We want smooth sailing and lots of continued growth. We want to have less risk of a economic contraction. We want more growth. We want more prosperity. And with the policies that we see coming to us in America as a result of this president and his ideas and his administration, I think that there's going to be a wonderful period of time in the next 2 to 3 years in which we're going to see economic expansion like we've never seen. But at the same time, that's the part that scares me the most. That's the part that I want you to be the most careful of. Because when I start hearing and seeing where investors, people just like you, economists, stock market gurus, are saying, well, this time it's going to be different. This time we're going to the moon. When you start looking at the volatility index called the VIX, and you see it going down, record lows, when you see consumer sentiment and consumer resilience, where even though prices have gone up, we've seen consumers not just shut their wallets and put away their credit cards, but rather they're doing the opposite. They're saying, well, I know that it's going to cost more, but that's okay. I'm still willing to spend the money. When you're seeing massive double-digit rates of growth and profitability within corporations, all of that is good. All of those things are optimistic. But all of those things also add to, or can add to, a false sense of security. This narrative that says it's never going to go down. And the thing that scares me the most is that this leads to what I refer to as investor cognitive dissonance. Now, what is cognitive dissonance? Well, I'll give you an example. You've probably heard that phrase, do as I say, not as I do. That's dissonance, right? You tell your kids, listen, I don't want you to text and drive because it's dangerous. And yet you yourself, as an adult, will text and drive because you feel as though, well, yes, there's a risk there, but I'm better, or I'm able to handle more things, and I'm able to multitask and pay attention to the road and pay attention when I'm texting. And besides, I'm not on the phone like my kid. And you begin to explain away, you begin to take and just kind of justify away the risks. There's many investors that I'm dealing with today that I'm talking to, and maybe you're one of them, in which you feel a definite uneasiness. You feel as though the market's getting near all-time highs. It's getting kind of frothy. Now again, I believe that the market is probably going to continue to go up a little bit more. How much more? I can't tell you. I don't have a crystal ball. I wish I did. You wish I did. But I don't. And neither do you. But you feel it in your gut. And even though you have a definite uneasiness, you're still willing to play the game. You're still willing to continue to invest. You're still willing, because maybe it could be something as simple as, well, just peer pressure. You don't want to tell your friends that you sold out of the stock market, because that's what you talk about every Friday and Saturday night. You don't want to be the guy around the water cooler that doesn't have his money in the market. Now again, Is this a message to tell you that you have to be pulling your money out of the stock market? And the answer is no. You have not heard me say that at all. But I do want you to understand that all of the things that are taking place today, all of the positive things, and I'm an optimist. I love to be positive. But as an advisor and a fiduciary, my job is also to warn. It is also to caution. And for many of you that are watching this, you've gotten lucky. When the first crash occurred, the dot-com bubble, you weren't even close to retirement. In fact, the dot-com bubble helped you a lot in dollar cost averaging. The Great Recession of 2007, 8, and 9, when the stock market was down over 50%, you weren't even close to retirement. And that time helped you even more to get ready for where you need to be. And so in many respects, with now the continued improvement to the market going up, you're getting emboldened. You're getting brave. You're saying, well, now I'm gonna double down even more. And that's the part that we have to be so very careful of. Now, if you're not a history buff, I don't expect you to know this. But the crash of 1929 was exacerbated because of what was going on within the stock market. Now, granted, there was less regulation in the stock market than there is today. There was a lot less regulation. But the reality is that back in the 1920s, investors were they were pretty poor. They didn't have a lot of money. There wasn't a lot of rich people. And for lack of better terms, we're going to say that there was bookies. And these bookies would borrow money. They would lend money to investors. And investors would take that borrowed money and they would go buy stock. They would speculate on stock. And the stock market, at the end of the day, if there's more buys than there is sells, well, the market goes up. And the market just kept going up and up and up. And even though these bookies were charging egregious rates of interest on the loans that they were lending to the individuals, the reality is that the stocks were doing better and providing more of a return than what the interest was that the bookies were charging. And so people would borrow money, stick it in the stock market, speculate, make money, sell it, and they would wash and repeat, and the market kept getting bigger and more frothy and overheated, and things were going on. Think about the technology during Calvin Coolidge administration. The technology of the day was automobiles and radios. Now, you laugh at that, and you say that's craziness, but that was for today. That was our artificial intelligence and technology. And all of the technology that's being created before our very eyes today. So you start to draw this parallel where human nature has never changed. Human nature has never changed. We are still driven by two major emotions. We have fear, and we have greed. The things we try to run from, the things that we try to pursue after. And guess what? Human beings, investors, are no different today as they were in the 1920s. We're still motivated by those same two emotions. And the thing I want to be so very careful to outline for us is that I feel very strongly that there is going to be potentially a big run-up followed by a very big fall. And we have to be careful of this. I'll give you just a little bit of proof. When we think about the 1920s, and if you've been a viewer of this radio show for any length of time, you know that I've talked about price to earnings ratios, PE ratios. These are the things that help us to take big numbers and shrink them down into numbers that our brains can comprehend. And interestingly enough, back in the 1920s, prior to 1929, the crash of 1929, we saw price to earnings ratios on average in the 20 to 25 range. Now, if we saw a 20 on a price to earnings ratio today, man, that would be like child's play. That would be amazing to be able to buy company stock with a PE ratio of 20 or even 25. But here's the thing. Because of how the market has evolved, 20 to 25 was like our equivalent today, 40 and 45 and 50. And folks, here's the thing. I know that if I was the best salesman in the world, you would never, and I repeat, you would never give me permission to spend $3 million of your dollars to buy some business like an ice cream parlor that made $100,000 of profit a year. If I was the best salesman in the world, you couldn't get me to do that. You wouldn't allow me to do that. Well, here's the thing. That's a PE ratio of 30. And you know what, folks? Today, when we look at the average stock market, you're seeing PE ratios of 40, of 50, of 60. There's craziness out there. There's companies out there that investors have run the price so high that they have a price to earnings ratio in the triple digits of 200, 300, 400, 500. Can you imagine? Who wants to pay that much for a stock when the company makes that little profit? Now, I know, sometimes it can be rewarding to be the perpetual optimist. But here's the thing. Are you ready for the fall? Are you ready? Do you have an exit strategy? Because, my friend, you've never been this close to retirement. You've never been this close. And when you think about how quickly markets go down, I think back to an investor, bless his heart, he's passed away now, but as a client, he said, Matthew, the market is like an escalator and it's like an elevator. He said, when it's going up, it's like an escalator. When it's going down, it's like an elevator. And you know what? He was right. He was right. He was absolutely correct. And the thing we have to be thinking about is we have to be asking ourselves, this close to retirement, is it worth me continuing to chase the growth when chasing the growth could literally cost me a third of what I've worked so hard to save? You see, this is the reason why things like in-service rollovers, once you're 59.5 from your 401k, from your 403b, why these things matter so much. Even the government knows how risky 401ks can be. That's the reason at 59.5 the shackles come off. But do you have a plan? Or is your plan just to wing it? Just cross your fingers and toes and hope that the market goes up and it keeps going up and it never comes down? Which you know better. You know better and I know better. I don't care how good you are at jumping up and down and shaking your pom-poms and saying, go stock market, go. I don't care how good you are. At the end of the day, if there's more sells than there is buys, the market goes down. If there's more panic than there is optimism, the market goes down. And again, I don't want to be a Debbie Downer. I believe very strongly that the market is probably going to continue to do fairly well over the course of the next few years. But are you ready? Do you have an exit strategy? Are you ready for the big fall after the big run-up? That's the big question. And if you're looking at me today and you're saying, well, I'll cross that bridge when I get to it, may I suggest that for most investors, that's not good enough. That's too late, is what that is. You see, there's a very real thing called the hindsight bias. And that's where, when the market is working its way up, even the most disbelieving investor will sit on the sidelines and go, nope, I'm not going to invest. And then eventually the market gets high enough. The market's clear up here somewhere. And they finally decide to get in. And they get in. The market might even go up a little bit more. But then all of a sudden the market begins to fall. And it begins to fall and it falls some more. And that disbelieving investor says, no. It's going to come back. But then eventually it falls enough that the pain gets so bad that investor finally caves and gets out. You see, my friend, this is human nature. It's those two fears. It's the fear and the greed, the two emotions. These are the things that I want to caution you about. I'm optimistic. I love seeing what I'm seeing happen. I think it's long overdue, and I see so many great things that are coming about. And I know you like it as well because it's making your account balances get bigger. And I want to see them get bigger. But I want you to also have a plan. And I want you, most importantly, to have a plan that you know is executable, to be able to take all of the money that you've worked so hard to save and do two things with it. Number one, keep it. Okay? It's not worth working so hard to get it if you can't keep it. Okay? And number two, making that principal produce income for you for the rest of your life, so that no matter how long you live, you can have the income that you want to do the things that you want. This is the go-go years. And these are the times in which we want to do all the fun things we can wrap our mind around. But we've got to be able to have the income to do it. And you want to be able to have the fun without all the stress and the anxiety and the fear of what a falling stock market could do to your retirement. So in conclusion, again, I'm just going to ask the question, does history tend to repeat itself? And I'm going to follow that up with a second question. Are you ready? Do you have a plan? Do you have an exit strategy in preparation for the fall after the big run-up? I'm Matthew Johnson. Thank you so much for watching. And remember, it's up to you to make today a great day.